Hey everyone, this is Janine Theus at Theus Wealth Advisors, and I am coming to you with a presentation of 2017 in review, a testament to economic growth and promise. And we're going to go through some of the numbers from last year and maybe some of the reasons why they were so good and what we can look forward to this year. Not going to predict anything because you never know. Could be a crazy year, but I think last year was much better than a lot of people anticipated. So would you have known ahead of time which asset class had the highest return for the year? Most people are focused on the US, so I think a lot of folks would have thought the S&P 5 was the highest return asset class, and they would be wrong. It was emerging markets. Which US asset class had the highest return for the year? Well, there you'd be closer to the truth if you said US growth, which is the S&P 5. Which asset classes will have the highest return for 2018? Now, my crystal ball is probably as murky as yours. No one actually knows that ahead of time. Lots of prognostication going on as to where the market's going based on interest rate rises, et cetera, but no one really knows. So I put this quote in here from Merton Miller on his co-Nobel laureates, Franco Modigliani. Modigliani told you about the one time he was right. Did he tell you about all the times he was wrong? And that is to say, no one knows what's going to happen ahead of time. There are a lot of guesses, a lot of predictions. And as I have said many, many times, based on the research, markets move based on news. And so looking forward, I think with the tax reform, with business growth, GDP growth, I'm very optimistic about where the market's going, and I still have no idea where it's going to go. But I have a pretty good feeling, but that doesn't mean anything when it comes to the reality of the numbers. For 2017, world stocks, as measured by the MSCI All Country World Index, were up every month. It's the first time ever without a single monthly decline during the year. And that's the longest stretch of time that the S&P 5 went without a 3 to 5% correction. Now, I'm sure somebody somewhere predicted that the S&P 5 or other world indexes would reach all-time highs with ultra-low volatility. But I can't remember who that was. Now, what I do remember is a conversation with a gentleman who told me about a local fund manager who's predicting a 1% return for the decade for the S&P 5. I don't know what crystal ball he's looking into, but I would tend to disagree with that outlook. For the fourth quarter, markets were up around the world. Domestically, the Russell 3000 was up 6.3, bringing the total gain for the year to 21. So that's pretty significant for returns in portfolios. Large growth stocks were the best performing asset class, as we mentioned. They were up almost 8% for the quarter. And small value were the worst performing asset class, returning 2% for the quarter. So this was the year, 2017 was the year that small US underperformed large. They still did well, they just underperformed the large cap stocks. International equity markets, that's the MSCI, returned 4.25 basically for the last quarter. And interestingly, outside the US, small cap outperformed large pretty significantly. Small was at 31% and large was at 24%. The best performing asset class for the second quarter in a row was the emerging markets index, up almost 7.5 for the last quarter. So about 37.75 really for the year. When it comes to stocks, parsing the asset classes is important because they often switch up and no one knows ahead of time where the returns will land. What's very interesting when I do portfolio analysis is very, very few people actually have small stocks in their portfolios. They may have some mid-sized stocks, but very few with small and almost none with international small or emerging markets. And oftentimes those asset classes are not offered in a 401k. So emerging markets growth index, which would be the small growth index, returned about 47%, while the value index returned 28%. very significant numbers if you don't have them in your portfolio. So let's talk numbers and facts. This is just a quick graphic of the market summary for fourth quarter. U.S. large was up, U.S. small was up less. International developed stocks like Toyota, Hyundai, Nestle's up pretty significantly, and emerging markets up significantly more. And of course, bonds were static like they have been for a number of years now. If you look at stock returns from the last quarter, 2017, and 1, 3, 5, and 10 years, the U.S. market has done very, very well, and this is including 2008. Now, it's going to be interesting to see what kind of year we have, of course, this year, because when you look back 10 years, it starts with 2008. And as we know, that was the worst year ever, 1 year return ever. And when I look at portfolios and how they're supposed to perform or expected to perform, I look at 2 years, 2008 and 2013. So if you've had the same portfolio, generally speaking, in terms of allocation, for the, between those years, we have a good idea of what to expect as a rate of return for the level of risk. So again, these were very good returns for all of these times, or all of these years. Non-stock returns, still very, very good. Last year was very good. And the international community or international companies and U.S. companies tend to flip-flop years. And you can't predict who's going to be at the head of the game in any given year. 10 years looks pretty bad because they got whacked as well in 2013, pretty hard. 2008. And then again, a little bit, I believe it was 2011. Emerging markets, it's a phenomenal asset class, always changing. And you can expect pretty high returns. You can also expect some pretty miserable returns in any given year because it is very volatile. But the returns do add to portfolios over time. When it comes to selecting country performances, you normally don't select based on historical past. Again, if you're forming a fund or using an international fund, they're going to be taking all these things into consideration, and you won't be overexposed to any one country because you have currency risk, company risk, country risk, etc. Now, who would have guessed that Greece would have been at the top of the game in 2017? If you look back, I believe it was 2012, when the Portugal, Italy, Greece, and Spain were having such miserable time of it. Greece was again at the top of the market then for different countries. And who would have chosen Singapore? It's such a small country to be at the top of the market. Fixed income, always pretty static, or it has been pretty static for the last 2 decades, really, with interest rates being so low. U.S. corporate high yield, those are often called junk bonds, and we expect them to have better returns for the risk taken because they are more risky than regular U.S. intermediate bonds or TIPS. So you do get a little bit better of a return. You also have, again, a risk factor there. But they are blended into portfolios. So when you look at alternatives, because a lot of times people will talk about different commodities. Should I buy this? Should I have an energy fund? Should I, and that is going to depend because sometimes they can be pretty volatile. But who would have thought that nickel would be at the top of the pile last year? And oh, look, there's gold at 1.8. I don't think Lear Capital and the other companies that hawk gold on TV were going to admit that the gold's performance was pretty sour. But if you remember, long-term performance for gold is 1.65. So you're not even keeping up with inflation. So as a part of a portfolio, the thing about gold is you own the manufacturing companies, the mining companies, etc., not gold itself. And it makes me crazy when I hear these advertisements about putting gold, tangible gold, into your IRA. That's insane. That's insane, and that's a topic for another presentation. So that's some bull we've just had. On January 4th, this S&P's Standard & Poor's closed at 2724, making this the biggest post-World War II bull market. So if you look at expansion of the market from 90 to 98. The total gain was about, so there's 8 years. Total gain was about 300%. But from March 2009 to January 24th, 2018, the gain was almost 320%. So what does this mean exactly? If you have a 25% bonds and 75% equity portfolio and you've had it since 2009 all the way to January 4th, when this graph was done, that's tripling the portfolio. Now, if you go back to the end of 2013, you would have doubled the portfolio. A lot of people, if they've been working with us, they pretty much have the same portfolio, and you can go back and look at those numbers, and that will be the case on a 25 or a 75-25 portfolio. If you have a 60-40 portfolio, it's about 1.5, 2 times what you would have started with at the bottom in 2008, or I'm sorry, 2009, when the market turned. So 2017 observations, the Dow Jones was up 28%, the S&P 521, the Russell 2000 14.5%, and then the MSCI World ex-US was 31%. Small stocks lagged large stocks in the US. Value stocks lagged growth stocks. Some of the gaps are significant, but value and growth tend to flip-flop. You can have a long period of time, 10 years, when value doesn't do very well, and all of a sudden it just explodes. So it's very hard to predict that. That's why a lot of our portfolios are geared or structured to capture some of that, even though we know that there'll be periods of time when you'll have flat asset classes. What's really significant here is 2017 marks the first time in history U.S. stocks beat bonds for 7 straight years. And that's pretty significant. Now, that's aided by the fact that bonds just haven't done very well for a number of years. And let's looking at the Dow Jones last 10 years, the big drop there in 2009, that was the bottom of the market, was actually 6,500. And so from 6,500 to 26,000 is a pretty big increase in the market, or expansion of the market. And we'll talk about that in a little bit more as to why that's happening. So from a historical perspective, because the financial media has a lot of people somewhat panicked as to what's going to happen next in the market, if we had a 10% correction, quote unquote, what would we drop back to? Well, 25.55, which would be, last October. So that's still pretty significant, or not as significant. I'm sorry. You'll be upset that the market has declined, but that's not a significant drop in terms of value. 20% is going to be a little more significant, but you're still ahead because we're really only back to December of 2016. So you have to remember that we had the fastest 1,000-point gain in history just recently, and that followed the fastest 1,000-point gain in history. So, we're looking at a lot of things here. 30% decline is going to hurt a lot more because we're going to go back to 2014. I don't see that happening. Not that I have, again, a crystal ball or the ability to predict anything. Other than probably what I'm doing tomorrow. But as where the market's concerned, a lot of market growth is going to be predicated on the growth of the economy, GDP, jobs, because markets are forward-looking. So they're factoring on all of these things, including tax policy and including deregulations, or getting rid of regulations that have been choking businesses for years. So when you stop that, and you begin to grow the economy, the market is going to respond in a very positive manner. So let's think about a couple things to put this all in perspective. GE is the only company remaining of the original Dow Jones companies, and it's failing its stock and bond holders miserably. In fact, those who were the bond holders whose entire retirements were in the bonds were hurt very badly back in 2009 and 10. So it remains to see how long that company is going to be around as it currently is. But here's the interesting point. The lifespan of large successful companies has never been shorter. A new study by a strategy consulting firm of the turnover of the S&P demonstrated 2 things. In 1965, the average tenure of companies on the S&P 5 was 33 years. By 1990, it was 20, and going forward, they're predicting it's going to shrink to 14 years. So that means about 50% of the S&P 5 will be replaced over the next 10 years if the churn rate holds. So why is that happening? Well, I would say technology is changing everything. And a true global entrepreneurial capitalistic marketplace is going to influence technology, and technology is going to influence the marketplace. And here's a couple things to just keep in mind. In the past 7 years alone, many renowned companies have been jettisoned from the S&P 5, and they include companies you're very familiar with: Eastman Kodak, National Semiconductor, Sprint, U.S. Steel, Dell, the New York Times, several others. Many companies on the list, the new companies, or the new guys on the block, if you will: Facebook, PayPal, Level 3 Communications, Under Armour, Seagate Technology, and Netflix. So when you're tracking all the comings and goings to the S&P 5 for the last 50 years, the study shows that the duration of companies that they spend on the list fluctuates in cycles, mirroring the overall state of the economy and the disruption from new technologies, including biotech breakthroughs, social media, cloud computing, the ability of the internet to allow you to run a company virtually. The overall trend is that the average tenure on the list is sloping downward. And as I say here, there are several reasons for the companies to drop off the list, but one of the primary ones is loss of market share due to competition. A lot of times you have companies that are acquired, so you have mergers and acquisitions. And I believe in one of my earlier emails, I put out a statistic that when you go back 20 years, the number of stocks available to be purchased in the U.S. market that were worth purchasing was about 7,600 stocks, and that number has been cut in half. Now, with the ability of companies to grow, expand, the companies that are bringing back billions of dollars from overseas into this country to grow the economy, create jobs, et cetera, you're going to see some major expansions. I think one of the most important, many of the important rules that have been negated are the ones that prohibit businesses from starting. And that's been pretty significant for the last 10, 15 years. So you're going to start to see an expansion of businesses and the growth of businesses, so that you're going to have more businesses, falling in and out of the S&P 5 to begin with. So that's going to be very, very significant. And I think that going forward is going to affect where the market goes this year. And it remains to be seen, and we'll have to see how it all plays out. But I'm very optimistic because of all of the reductions in rules and regulations that are hurting countries or companies. So it's going to be, again, it's going to be very interesting to see. This is how a lot of people feel when it comes to the market, even in good times. People have made a comment about speculation, etc. But speculating is a behavior, and the market is the market. So the bear market can be caused by a number of things, and this is what most people are afraid of, and this is how they feel, that the bear market's going to steal your lunch. And so there's definitely some strategies to fight against that, if you will. So we can show you how to do that, and we are doing that with our clients. So you have to beat back the bear with proper, prudent investing strategies. So what are they? Put things in perspective, have some patience and discipline, and understand what your overall strategy is. So making predictions is easy. You hear it every day. If you go to MarketWatch, there are at least 4 or 5 or 6 or 10 every day. They often contradict each other. But making predictions that are both actionable and are repeatable is impossible. If the Nobel laureates can't do it consistently, what makes you think that talking heads on TV or a local fund manager or an opinion writer can do it? The only way to be successful, to invest and worry less, is owning the market in a true globally diversified, properly allocated portfolio. It's the only way to do it efficiently, to access the returns of the markets without attempting to stock pick, market time, or use past returns to predict future performance. Those behaviors are speculating and gambling, and in the end, it's a zero-sum game. We use returns data to understand what is normal for different asset classes and for blended portfolios. The allocation of non-risk to risk assets is designed to protect against downside swing. Everyone wants to run with the bulls, especially when the market's on a tear. But I'm betting no one wants to be gored. And that's what happened in 2008. And so we avoid that through proper allocation of the risk to non-risk asset classes. So it's why we use the research and the science of Nobel Prize winners and not Wall Street's media machine. So thank you for attending the presentation. I hope this was helpful for everyone and that you got some perspective on actual returns. If you have any questions or would like to discuss particulars of your portfolio, don't hesitate to give us a call. Thanks very much.